Hello and welcome back to 1% Weekly, and thank you very much for all the feedback on last week's special episode where I analysed Jeremy Corbyn's speech at last year's Labour Party conference. To those of you who said how scary it was, that was my intention. I just felt that it was so important to try and shake people out of this complacency, because we've got a very viable leader of the opposition now. But when you actually analyse what he's proposing, there's some pretty scary stuff in there. So, we'll be coming back to that over the coming weeks and months. There's lots of specifics we need to talk about, but at least that sets the scene for you on one of our major themes for 2018, which is how to Corbyn-proof your wealth. Coming back to this week's episode, in a moment, I want to share with you some things that came out with a great talk we had by Ross Norman from Sharps Pixley at our Elite Investor Awards ceremony towards the end of last year, and that was comparing gold with Bitcoin. I also want to talk about some strange goings on in Saudi Arabia, which is going through a kind of a silent revolution and bloodless coup at the moment. And then I want to introduce you to a brand new division of Elite Investor Group that we've launched this year called Elite Tax Planning, and introduce you to my partner in that, Jeff Lerma, and we'll just talk about some of the things we're going to cover in coming episodes to really help you understand whether tax planning is right for you and whether it's something you should be looking at in more detail. So we'll get back to that in just a moment. This week's Investor Insight, I want to look at gold, which is the well-known, well-established store of value, versus the kind of upstart younger brother, Bitcoin. What have they got in common and what's different about them? Well, at the moment, obviously, Bitcoin is just absolutely racing away. Even with the setbacks over the holidays, it's still had an amazing year in terms of its price growth, as have all the other big cryptocurrencies. This has become the kind of speculative bubble of the century. But obviously there's some great stuff about Bitcoin. One of the things it was originally designed to do was to be in limited, finite supply. And that's very similar to gold. As you know, all the gold that's ever been mined throughout history would fit into a cube the size of a tennis court. So, there's a very finite amount of it available, which is always, you'd imagine, going to lean towards keeping its value and perhaps increasing its value over time. But there are some differences between them. I think what appeals to me about gold really essentially is it's an insurance policy. I agree with Warren Buffett, it doesn't pay a dividend, you have to pay to store it and pay to insure it, but it has been around for 5,000 years as a store of value. Just give you an example of how it works. If you just look back over the last 30 years, from 1985 to 2015, let's measure some everyday aspects of life in gold versus a fiat currency like dollars. So in 1985, you'd be spending probably $9,000 on a car. 2015, you'd have to spend $27,000 on exactly the same car. If you look at that in terms of grams of gold, in 1985, it was 857 grams. By 2015, it was 739 grams. So barely a 10% difference versus a 300% difference in dollar terms. If you look at the cost of fuel, even though, assuming this is American prices, are very cheap, it went from $1.16 in 1985, and that's probably for a gallon, to $2.51 in 2015. With gold, it went from 11 grams to 7 grams of gold in that time. So, and if you want to go out for entertainment, a cinema, something like that, in 85 it would have cost you $2.75. In 2015, $10.25. In 1985, in gold, it would have cost you 26 grams. 30 years later, it would have cost you 27 grams. So gold is a store of value. And when you look at how fiat currencies have lost 99% of their value in the last 40 or 50 years, that's why I see it as an insurance policy against a meltdown. So I always say to people, somewhere like 10, 15% of your portfolio should be in gold. With Bitcoin, Yeah, it's limited in supply, but obviously it's only 2 or 3 years old. It's got no track record yet. We have no idea where prices are going. They could keep shooting to the moon the way some people think. There could be a collapse, perhaps banning by governments and so on could lead to it becoming worthless. So it's just too early to tell with Bitcoin. I don't mind people speculating on Bitcoin. I think if you put money you can afford to lose into it, why not? I'm kind of slowly coming around to the idea I might as well have a punt on it, because you start having this thing they call FOMO, fear of missing out. So you see the price going, I thought it was in a bubble at $500. I was convinced it was in a bubble at $1,000. Now it's up above $11,000, $12,000. I've got egg on my face. I've completely missed all of those gains. So who knows? I'm not that smart. I might just have a punt myself, but literally only with a little bit of money that I can afford to lose, because it's just been such a roller coaster ride. Yes, it may be the future of money. It may be different this time. It's just a little bit too early to tell. So at the moment, I've got way more in gold than I have in Bitcoin. I'm perhaps going to put my toe in the water of Bitcoin, but I've got a very clear strategy when it comes to gold, and I've just got an interested spectator, maybe a little bit part player when it comes to Bitcoin. Saudi Arabia has always been a bit of a strange country, but things have just got a lot stranger in the last few months. There's what you could almost refer to as a bloodless coup going on. I don't know how much you've been following the story, but the Crown Prince Mohammed bin Salman, known sometimes as MBS, has essentially taken over from the aging king and has got himself in charge of all the major power bases in Saudi. And he's put all of the royal family hangers-on under a kind of house arrest in one of the best hotels in the world. So it's both the height of luxury and, of course, a prison. He's also frozen bank accounts and stuff like that. He's almost kind of dismantling the old family tribal rule that's going on out there. He's doing some things that appear to be socially progressive. Women can now work without needing the permission of some guardian. They can drive cars, and they can get themselves properly educated. But he's also, I think, recognizing that Saudi Arabia cannot be a one-trick pony. It's actually no longer the biggest oil producer in the world. That's now America. What Saudi has is a very young population. The average age is below 30. And although overall unemployment is about 12%, youth unemployment is about double that. Now, up to now, they've always been able to just make generous payouts from the state and subsidies and all sorts of utility bills and so on to keep people quiet. But with the oil price having gone down a lot, although it's recovering a little bit recently, their model, their business model for running the country simply no longer works. So think about this. Since January in 2018, Saudi Arabia has introduced VAT. Now, initially it's 5%, but we all know these things get introduced at one level, and then of course if the government needs a bit more money, it'll just get ratcheted up to perhaps even the 20% that we now pay. Joy of joys. They're also now introducing income tax on expat workers. Now, apparently the employers are going to pay that, so they'll still feel motivated to go and work in their pens and in their fenced-off estates where there's no liquor and no women or whatever. This will still hopefully keep attracting those workers. But it looks like what he's trying to do is introduce a more widespread, diversified economy. There's talk of new tourism resorts being developed. He's actually going to reintroduce cinemas, which were banned by the clerics back in the 1970s. So it sounds like a degree of liberalization, and also obviously trying to remove or reduce the dependency on oil. And perhaps the biggest, most interesting development of all is that they're going to float the national oil company, Aramco. Now, What does that tell you if somebody wants to kind of float and partially exit a business? Usually to me it tells me that it's at its peak value and they only see it declining over time. So it'll be interesting to see. It's such a big company with such a massive enterprise value. I don't know whether it'll be too big to float on a normal stock market. They're looking at all their options at the moment, but I think that's another sign that they recognize that the oil days are not going to last forever and that they need to get a bit smarter with how they run the country. What it means for the rest of us, I don't know. Obviously, we're still selling them loads of weapons that they're using in some pretty ugly wars. And so it's not exactly a country that you'd want to get involved with from an ethical investment point of view. But certainly if there's a bit of social freedom and progression involved there, then that's got to be seen as a good thing. But keep an eye out on these developments, because I think that the whole of the Middle East is still a potential powder keg. Saudi's right there in the middle of it. There's been all these quarrels with Qatar, all the problems they perceive with Iran, etc., etc. So yet more change going on. The Crown Prince is being very aggressive in implementing these new policies. It remains to be seen whether they'll be successful or not, but right now there's an awful lot going on in the Kingdom of Saudi Arabia. And now for our tax tidbits session. Now, for the first time with 1% Weekly, we have a studio guest, and I'm going to introduce him because he's a very modest guy, but I have to tell you, he is one of the top tax experts in the country. He gets invited to sit on Treasury committees when they're discussing changes to taxation. He's on a global panel of accountants and tax experts, and he's already done some amazing work for Elite Investor Club clients. And after a lot of thought in the latter part of 2017, we decided that it was really important to launch an elite tax planning service and make it available to our wider membership. So for this first interview with Jeff, we're going to focus on an overview of all the things that are relevant to people who need the services of a tax planner. So here's my first chat with Jeff. So Jeff, as we come into 2018, we've decided to launch elite tax planning because we just saw so many situations in the last year and a half where we thought it could really help clients. What do you think are sort of the biggest areas where we could make a difference through this service?
Well, we thought about it was great to have obviously the opportunity to work together because you've got some amazing people that you're working with. And the trouble, obviously, I know when we discussed it, you realised or said, they're not getting, or many aren't just getting advice in that area. So we thought, well, let's work together and create something that's going to be fantastic. So the areas we look at lots of areas. I mean, really, the whole point is there isn't a set. If this happens, you do this, or there's always one solution. The idea is actually it's a matter of listening. We really need to listen, understand what people want, understand the intricacies of their affairs, understand what their long-term plans are, how they see the future, this, that, and the other. So really it's very much listening, but as far as the problems that what we're doing, what we look at, first thing, often people don't ever really stand back and look at their remuneration, how it's planned, how much they're spending at Sainsbury's or probably Waitrose with your people here, and once you know that number might be 3,000, 5,000 a month, it might be 40,000 a month in certain cases. Once you know that, you can actually then plan everything around it because they have a business, they have investments making a certain amount of money. So the first stage probably is a remuneration plan. And it's not sort of, to cut people's money down, it's actually say, what are you spending? What are you spending on holidays? And just bring it all together so we can actually properly plan it out. And with that in place, everything flows through.
But isn't there also, I think, almost a starting point is people need to understand that having like a tax advisor is quite a separate and quite a specialist thing compared to just having an accountant. Yeah,
what happens is that people go into business or people get advice, and the first thing they tend to do is get an accountant. Depending on where they are in their business, it might be a sort of a typical one who's good at startups or wherever they are. But ultimately, the training to be a chartered accountant is fantastic, but it's very, very broad. actually, when people create a certain amount of assets, it needs to be much more targeted. And what generally happens is they just stick with the accountant that they've got. And as a result, people take it as a lot of compromise. Or even not knowing what questions to ask. So with Elite Tax Planning, we've got the ability to really delve in and help people. And it's not a matter of being sort of disloyal to your accountant, because actually it's working together to actually create something that works really well for people. So the tax advisor, we've got a massive amount of skill within the practice of myself. We've got chartered tax advisors. We've got really strong, knowledgeable people that spend their life trying to help people with their tax. So that's what, and it's different from an accountant whose role really would be preparing accounts, doing personal tax returns. So it's a different focus, it's a different degree of skills. And then we found if people actually focus on it, they can suddenly make a massive difference to their life by structuring it in that way.
And of course, in the context of the Elite Investor Group, one of the things that people are most concerned about is saving, acquiring assets. A lot of them have property investments. So what are some of the areas that we can help with in that kind of saving and investment scenario?
What we look at, I suppose, is that the average tax rate that can be created within what they're doing. Maybe within a company, we've got corporation tax rates, which are typically significantly lower than personal tax rates. So that might be the right thing to do, with the appropriate amount of safeguards in there to protect people. It may be looking at people's pensions. Pensions are, at the moment, absolutely fantastic. The ability, tax relief on the contribution going in, growing tax-free. Their limit really is the fact you can only get sort of £1 million per person. But within those realms, it should really be a really good part of anybody's strategy to get tax-free investment growth. Doesn't work with residential property, so it's not universal. It's not sort of, and if people like that or they like houses of multiple occupancy, then it's not going to work. But there's things. So it's really sort of understanding what people want and then getting a structure. Because then if you see their whole entity, what they are, what they're producing, the amount of profit they're making, and seeing, well, can we keep them in a sort of sub 20% world? Well, it's a good place to be.
So I guess tax planning is a mixture of proactively putting the right structures in place and then reacting to things that come out of left field, like say Clause 24 that's impacting so many buy-to-let landlords.
Absolutely, it's not a one size fits all. When that clause came up, it absolutely shook up the market, and we had to be flexible. We had to look at different options. Sometimes you can do things what people have got at the moment, sometimes for the future, but it makes a big difference, and that's why, for the whole purpose of having a tax planner, is it's flexible. It's not one size fits all forever. It changes, and that's the benefit of having your affairs actively tax planned.
So I think what we'll do over the course of the coming episodes is we'll go into each of these key areas in more detail so that people can see whether tax planning is appropriate to them. But my own sort of generic take on this would be that broadly, the higher your income and the more assets you acquire, the more likely you are to benefit from tax planning. Would that be a fair?
I think that's fair to say. Sometimes not always the case, but that's fair to say. Some people may be likely to be inherited some assets. Maybe there's some work they can do beforehand. So yeah, no, I think it's fair. It's a good way. It's a good broad brush way of doing it. And yeah, let's say what we do is also take a holistic view about how people run their affairs. But if they've got more money, more assets, there's often more you can do.
I think finally, it's worth saying that when we talk about tax planning and the sort of things that we're putting in place, it's not the kind of exotic stuff that ends up in the headlines with celebrities being named and shamed. This is real kind of mainstream stuff.
We're in 2018 now. There is absolutely no place for that sort of planning. But things change. It was, there was a time when actually it was accepted. But the trouble is we forget how things change so quickly. And now there is no place for that. There is a place for good, solid tax advice, which sometimes means you're not going to eliminate people's liability. You might change their tax rate. You might move a bit around. You might get to pay it a bit later. It's helping. There's not going to be a sort of you will pay no tax. There is no place for that now.
Okay. Jeff Lerma, thanks very much for joining us.
My pleasure.
So hopefully you can see that this is a really important new development within the Elite Investor Group. Tax planning is something that many of our members need to get on top of. It's not always a priority. There's always something else. It all seems a little bit boring. It's a bit like talking about pensions, tax, oh my God. But look at the difference it can make. You know, it can be a multi-million pound difference to your family's net worth over time. So do get in touch if you think that's relevant to you. So that's it for another episode of 1% Weekly. I hope you've enjoyed the variety of material we've covered. We've got a lot more interesting stuff coming up for you over the coming weeks. And if there's anything else you'd like to specifically see, do leave a comment below and do let me know what you think of some of the topics we've covered. It's really important that we get a dialogue going and share opinions on this. So thanks for watching. I'll see you next week.